Being the owner of a retirement planning firm and a tax prep firm, I've seen hundreds of people use these 7 investments not only to reduce taxes, but also to create tax free growth and tax free income. 4 of them you might know and you've heard before, but 3 of them are a little bit different. And many people have not explored these options. So I want to make sure that you know about these ones too. And if I haven't met you yet, I'm Dave Zoller. I own Streamline Financial. It's a wealth management firm in Illinois. And then I've got a tax planning firm called Zoller Swanson as well. And my team and I, we've been helping people retire personally for the last decade and a half. And we really are focused on simplifying their financial life and just retiring with confidence. The goal of this channel, though, is to just share the tips and the strategies that have worked for successful retirees and share it with you. So let's get to the first investment. This is one that I'd say isn't for everyone, but it can offer a big tax incentive. So it's worth mentioning. And what it is the exploration and drilling and production of oil and gas resources. This type of investment, oil and gas, it's often made through a partnership, or it's really a pool of money from multiple investors. So multiple people are putting it in the pool of money or a fund here. And this fund then funds the operations of the rig or the oil and gas partnership. And then the partners receive the profits and the losses based on the investment share that they have. Now, what are the tax benefits? So the first question is it tax deductible? So let me show you just on this simple thing. So first, is there no tax on the contribution? Is it deductible? And this would get a green check mark, yes, because one of the big advantages, the tax advantages, is the ability to deduct the intangible drilling costs, or IDCs, which sometimes equate to, could be 60 to 80% of the actual investment amount. So there's one other investment in this video that that beats that, but IDCs, they include expenses related to things like the labor or the chemicals or the other non-salvageable costs that happen during drilling. And these costs, they're usually fully deductible in the year that they occur. And to put some numbers to it, take the investor he had a big income this year, and the tax projections that he runs with his tax planning firm shows big taxes owed as well. So if he invested $100,000, he was able to deduct over $60,000 on his tax return for that year. Now, the nice thing about participation in oil and gas is that the deduction can often offset other income, which is a big deal because it's almost like well, I'll get to real estate coming up as a sneak peek, but this idea of offsetting other income, whether it's W-2 income or your just other business income, if you're a business owner, or other investment income. So it's kind of like when you think about real estate, you can't do that with your real estate depreciation or deductions unless you meet specific criteria. And I'll mention that one next and give you some of the details. But back to oil and gas, do you pay tax on the income? Well, I'd say this is green as well because you don't pay tax on all of it. Typically, 15% of the income is not taxed due to something called depletion. So it's kind of like depreciation when you've got a real estate investment, but the depletion allowance, that lets them deduct a portion of that income based on depletion of the oil and gas reserves. And then finally, is there any tax on the sale? And I would say this one is a red. So there's tax recognized on the sale, but really the goal here is to receive cash flow each year from production. But the big tax advantage that happens in year one, but maybe year two as well. But if the investment is sold and it's at a gain, then it's going to be taxable. So you can see a lot of the tax benefits here for this one. But remember, this isn't for everyone. This can be really volatile, right? There's some uncontrollable risks, things like fluctuations with commodity prices or regulatory changes, or just the drilling uncertainties is a big deal, right? You don't know. So it is higher risk in my opinion. But now let's move on to real estate investments as number 2. Now, not your residence, your primary residence real estate, but income producing properties or investments. So the first question is Is it taxable? Let's see. So for real estate, I'd give this a green. You can get a deduction here, but I'm going to put a little asterisk here. It all looks the same, but the asterisk, I'll explain what that means. So let's say you invest $1 million. You're going to start depreciating the real estate asset in year one, right? And also, there's a strategy that investments or investors can use to accelerate the depreciation of the building and get more of a deduction in year one. So larger deductions. So I would consider that a deductible investment, and I'll give you a little bit more info coming up. But that offsets other real estate income. But there's also a way for non-real estate income to be offset as well. Now, what about for no tax on the income? Well, I would say yes, this checks the box as well, because in most cases, you can offset your income received from rents and property expenses. Imagine this. So let's pretend like you've got rents coming in, income of 50K per year. Well, it's common for mortgage interest, real estate taxes, utilities, depreciation, all of these other expenses to actually be a greater loss more than what the rents are. And the big one here is the depreciation of the real estate asset. So actually on paper, negative 10K in this scenario, but most likely that 10K, that's going to be considered passive activity loss, which is not taken in the year that it occurred, but it's carried over to the next year or used in future years whenever the property is sold. If it's sold at a gain, that's when it's recognized. Now, there's ways to benefit from it now in the current year. Number one is you need to be considered an active participant in the rental property. Now, to qualify for active participant, you must have a significant role in the management or the operations of the rental properties. There's some limits as well. And again, all of this stuff, you're going to be talking to a CPA. You need to talk to the experts before getting deep into this. But if your adjusted gross income or modified adjusted gross income is below $100,000, maybe I'll just write that out for you. So if it's below $100,000, you can deduct up to $25,000 in passive activity losses against other income. And then it phases out as your adjusted gross income goes up and goes up to about 150,000. It starts to phase out. Now, there is a way to write off all of the losses against other income without limitations. That's if you qualify as a real estate professional. But you can't just say that you're a real estate professional and take the big loss there. You have to prove that you are one. And to prove that you are one, you've got to spend more than 50% of your total work hours during the tax year in real estate business and things that you materially participate in. So that's hard to do if you've got another job, right? That's not in the real estate industry. So there's specifics here that, again, talk to your CPA. That's what's recommended here. Now, let's get back to the tax benefits. So is there any tax on income? And we already went over that, and we would say that checks no tax on income. What about tax on the sale of the asset? Well, if you sell the property at a gain, the answer is no. You pay tax on the gain. But there is a strategy that families use and been using for some time, and that's just called the 1031 exchange. If you're using a 1031 exchange, if you've got the long-term perspective, that's a green. So I would say 1031 exchange is when you've got the real estate asset that's sold. If you move the proceeds into another investment, you won't have to recognize the gain that year. And it's then kind of wrapped up into this next one. And the cost basis is carried to this one as well. And the reason why families use this is because if this is a lifetime asset you want to keep in the family, whenever you croak, that asset can be passed on to your heirs. Let's pretend you have two. And at that point, the cost basis back from the original one steps up. There's a step up in cost basis where it's almost like there's all that gain is wiped out. Now, the actual dollar terms, if this was $100,000 property, it grew to $1 million, and you move that 1031 into this property, and it grew to $10 million, and it's passed on. The kids' basis is now $10 million, and if they sell it at that price, no tax. Again, there's specific rules here. You got to talk to the professionals and get this organized if you're doing it. But overall, real estate, it's a great investment that reduces taxes, in my opinion. Next is the investment that you've heard of, but we've seen a lot of high net worth people or clients want to over allocate to this because they get excited about it. Because what it is tax free income, exempt from federal tax, and it's got relatively low risk. So that seems like a wonderful investment, but it's not always the best option for them. And there's risks that they're not thinking about. And that investment is municipal bonds. So the big risk here is that municipal bonds in general haven't kept up with inflation, which really reduce your purchasing power in the future. They're great in many ways, but you just want to be aware and careful of what the right allocation is. I talked to someone recently who's actually doing something with real estate like the previous answer, and his neighbor keeps telling him he's got to be invested more into these munis, and all he's showing the neighbor all these things that he's done, and it sounds great. It sounds like a great idea, but when you map it out in a retirement income plan, it's good for a portion, but over allocation to any one asset, especially munis, it didn't really look good for this person. But let's focus on the tax advantages. Number one, tax deduction. Is it tax deductible? So if you purchase it in a brokerage account, then no, it's not tax deductible. But what about the tax on the sale? If it's like other investments, stocks or bonds included, if it's in the brokerage account and there's a sale, then whatever the gain is, you're going to pay tax on it. Now, there's one caveat to that, which I'll get to. And now, what about the tax on income happening every year? Well, munis, they're not taxed federally, but they're often taxed at the state level. So 43 of the 50 states, they do charge state tax for out-of-state muni bond interest. So munis are a way to get tax-free income, but no tax deductions. And of course, when you sell it, if it's in a brokerage account, you're recognizing the gain when you sell it. Of course, if you're buying these munis in an IRA where you actually get a deduction. So as you already know, just a quick picture here. If you've got an IRA here and you're going to say, let's put in some money and purchase munis inside, well, yeah, you'd get the deduction here when you add money to the IRA, but then you don't really get the benefit of the tax-free income inside because everything's kind of wrapped up in this IRA. So this is actually an issue, not just for munis, but for other asset classes as well, because this is considered one of the risks that we see is asset location. We see some people holding the right asset classes, but they're in the wrong type of accounts. And just to simplify, you've got taxable accounts, you've got pre-tax like IRAs or 401ks, and then Roth accounts. A lot of times they've got assets in the wrong type of account. And speaking of accounts, I want to include a few specific accounts in this video that are tax advantaged and really beneficial that you want to know about because you can hold almost any investment in them. And then after that, I've got two investments that are going to check all three of these boxes of deduction, no tax on the income, and no tax on the sale. But let me know if this type of video is helpful by clicking the like button. It just helps me understand what sort of future videos I should do more of, what I should do less of. It's helpful as hopefully it's helpful to you. But the next investment is the traditional IRA or 401k or solo 401k, which almost any investment can go into. And if we pull it up, is it tax deductible if it's traditional? Well, yeah, the answer is yes, it is. There are some income limits though on traditional IRA contributions. Also, just quickly, it's not deductible if you contribute to a Roth IRA. But what about no tax on the income? Well, income, when you think about it, I'm going to give this a red because when you're going to take money out of your IRA, that's going to be taxed at ordinary income levels, right? So anything that comes out, when it's inside, no worries, but when it comes out, it's going to be taxed. Well, what about tax on the sale? Well, I'm going to say it's part yes and also part no here. The great advantage of these type of accounts is as long as it stays in the account in that IRA, you can sell investments. You can sell investments at a great gain and not pay tax. But when you withdraw the money and use it and it comes to you, then it is taxed. So quick mention here though, for Roth, no deduction for Roth, but there's no tax on income and no tax on sale because all the money that comes from a Roth IRA should be considered not taxable to you. Now, the next one is considered triple tax advantage. This is one of the good ones, and it's one of my favorites because of it, and that's the health savings account. If you're already retired, though, you might be wondering, can I still use this sort of strategy when retired? And the answer is yes. And I'll show you how to do that. Now, the reason I call this the triple tax advantaged account is because it checks all three of the boxes. The HSA, and you know what I haven't been doing is writing the names up here, and I apologize for that. But the HSA, it is tax deductible. Yes, up to $8,000 for married filing joint or $4,000 for single. And there's no tax on the income here if it's spent on qualified health insurance costs. And then there's no tax on the sale, kind of like an IRA. You can buy and sell within the account and you're not recognizing the gains if it all stays within. So it allows for tax-free growth as well. So really you can add to the account and have individual stocks or funds or whatever it is, any type of investment, and buy and sell, and it's not going to be recognized if it stays within the account. Now, to qualify, one of the questions is, what if you're already retired? Can you still take advantage of this? Yes, you can, but here's the rules that you gotta fit. It's to qualify for an HSA, individuals, they must be covered by a high deductible health plan, which is a health insurance plan with higher deductibles and also lower premiums than traditional healthcare plans. Number two, you can't be enrolled in Medicare yet. So under 65 typically is what we see. So if you retire, anything under 65, it's a possibility. Now, if a retiree is enrolled in Medicare, they're no longer eligible to contribute to an HSA. But once they turn 65, they can still use the funds in the HSA for those qualified medical expenses and do it tax-free. So that's a great benefit. They just can't contribute to it anymore. So generally, the individuals, they can't contribute to an HSA if they're covered by any other any other health insurance plan out there that's not high deductible. And for those of you who are 65 now, you may be able to roll over your HSA into a Roth IRA, if that actually makes sense. So talk to someone about that, but that's a nice perk as well for this account. So there's quite a lot of benefits to that HSA, but then the next one, actually, I'll go over the next one, and then the one after that is the big one that I'm most excited about. So the next one, though, that's something that we're seeing a lot more retirees invest into, but you might be surprised and wonder why they're investing into this. And what we're seeing is they're investing into the small business. So if you're a business owner, you already know what the benefits are for investing into your business, right? There's a lot of tax benefits to doing that, but I'll share some of them, and then I'll share examples of what some people and what some clients are doing in their 60s and 70s. And well, let's get to the rules here. For a small business, and I'll just say small business, is there no tax on the contribution? So is it deductible? And I'm actually going to say yes for this, because in a small business or business in general, you're paying expenses first, right? Now, if you're in a home, if you've got a small business and you're actually earning and making some money, if you've got a home office, you can start to deduct a portion of the mortgage interest, the rent, the vehicles, the utilities of the home. And if you're an pretend just as a real example, an artist, got clients who are artists, and they will actually paint and sell pieces on the weekend. And your studio in your home, you can deduct part of all the supplies that you use for this hobby that you have, but actually earns money. That can be deducted as well. So it's an interesting way to deduct part of your lifestyle. That's what a lot of business, even travel sometimes can fall into this, or your car and auto expenses. Now, again, talk to a CPA about this, but there's some interesting ways where you can have a small business that brings you joy and fulfillment in retirement, or if you're not retired, and actually deduct some of the lifestyle. So what about income? Is there any tax? Is there no tax on income? And I would say this is a partial yes, but also no, because you can deduct a lot more with a small business than if you had a W-2 job, but the net profit is taxable. So the other thing, what if you grow equity? What if this business grows and you actually have equity inside it? Is the sale of the small business taxable? Yes, it is taxable. So there is tax on the sale. you'll recognize it. There are some ways. We do talk to people about ways to lower that tax on sale and still have everything that they want to accomplish from the sale. But that's more for mid-sized businesses and things like that. But the biggest benefit here is that business owners can deduct their part of their lifestyle and their income producing activity. A few other examples here, other than the artist, is a couple they've got a green thumb and they are planters. They're out in the garden and they're farmers. They're mini farmers, I guess you could say, but they'll sell their produce at the market, right? And we know freelance writers who write for blogs just from their bedroom, right? Or magazines and things like that, or consultant services. You've got a lot of experience probably in what you've done and wisdom in what you've done. So you can be a consultant for people as well, or for businesses. So just a few ideas on how retirees are actually using this, only a few days a week or a few hours a week. Now, the next one is the one I'm excited about. This is the investment that gives you the best tax benefit out of any of these, because unlike an HSA, the limits, HSA, max 8K deduction per year, but the limits here are much higher. And you can get a full deduction for whatever you put into this investment. So you get immediate deduction on the full amount invested, and then it stays invested and it grows tax-free. And then third, there's no tax on the income. But the interesting thing here is most people don't view this as an investment, but I can explain it and why it is an investment just with this picture. So this is inspired by Greg Lernahan, who's a friend of our company. And the previous investments we looked at, they all fall somewhere onto this chart, right? We looked at oil and gas, and this is just risk going up the more you go to the right. So oil and gas, pretty risky. Real estate, munis, maybe a little bit more conservative. And that's the growth scale there. And the ROI, the return on investment, is really towards yourself. You're getting money back and you're earning something and you're continuing to grow your assets. But if you've ever donated money, you're investing, but for the benefit of others, return on investment for others. Your dollars are actually changing the world for good, right? And there's still a growth scale here on the right side, the risk and the growth scale. Over here, we've got something called impact investing. Because did you know that you can actually get a full deduction for money invested to help another business grow? And the growth can actually come back to you and be given again. Let me show you just a quick example here of this idea of impact investing. So this is here a donor advised fund, and you can put money into this donor advised fund. And when you do, you get a full deduction on the contribution. So yes, it's deductible, and then it can actually stay invested, and you can have it invested in many different types of investments. And if there's growth or if there's income, there's no tax on the income and then no tax on the sale, whether it's for you or whether it's for the investment that, or the charity that you give to. And this one here, this is kind of like a foundation, but without the foundation costs. And then you've got this as an asset to decide, this year we're going to give to church or we're going to give to charities. No, next year we're going to do this, and you decide when and where the grant goes. So that's a donor advised fund. Now, a lot of business owners we've seen, but not just business owners, but really anybody, is starting to get interested in this idea of impact investing. That's where you give your charitable dollars to invest in companies that are doing good. And as an example, if you put money into that donor advised fund and then you grant money to an impact fund, and one of the investments is a small motorbike company in Uganda, and the mission there is to employ the local men to support their families, right? To earn a living and support their families. This could be considered impact investing. And if that company grows or if the company is sold in the future, the financial return ends up coming back to the donor advised fund, but in a larger amount. So it all stays in the charitable bucket. That this is becoming more popular. So it's something to, if you're interested, look into it, but you'll need to talk to an expert again to get the real facts and make sure it's being done correctly. And this video is really just to make you aware of some of the things out there and what's possible. But the big thing is, think about, the investments for self and then the investments for others. These are really important because we know how the world's broken, and it just seems like there's so much more bad than there is good, but we just don't see the good on the news, right? And enough of us, if we can do things and actually help others and do good. Like, this is how I imagine it. If we can, this is kind of what the world looks like to me sometimes if you look out and watch the news. But if there's enough pockets of people doing good, we could start to see some clarity and some goodness, and hopefully it could be expanded and connected. Now, in reality, I don't have the time to start a nonprofit that helps kids out and lifts them out of poverty, but I can give my money to assist those people that mission in their mission, and I can give my time. Even I actually joined a board, Flourish Rwanda, which is helping 100 kids. That's all, to break that cycle of poverty near Kigali, Rwanda, the capital. And I'll include the website below if you want to check it out. But at Streamline, we've helped our retirement clients find those missions around the world or their communities that they have right here. And we've worked on their giving and putting it into their income plan, which has helped a lot with fulfillment and purpose, something greater than themselves. So they're making an impact. If you want to learn more about charitable strategies, check out this DAF strategy video here. And I hope this video is helpful. If it was, give it a like and then spread it. Give it to somebody else. Give the positive message, hopefully, to somebody else. And then if you're subscribed, I'll see you in the next video as well. Take care.